everyone. Today is September 6, 2022. I am Ashley Wilkins, Senior Wealth Manager with the Rice Partnership, and I have Orest Saikevych here, our Chief Investment Officer. Hi, Orest.
Hi, Ashley. Hello again, everyone.
So earlier this year, we talked about the possibility that if the S&P 500 dropped below 3,800, that it was possible it could go down to 3,400. Right now, the S&P today closed right above 3,900, but has been very volatile. So now going forward, what do you think the probability of the S&P dropping all the way down to 3,400 is based on the information today?
Well, Ashley, it's really a question of economic fundamentals, and specifically that of inflation and the Fed response. If inflation remains elevated, say over 5%, then the Fed will probably raise the Fed funds rate to 4% or higher. Chair Powell has indicated that at the Jackson Hole Symposium just last month. And that could cause the Treasury yield curve to fully invert, even the 3-month to 10-year portion. And that would signal that we're probably going to have a recession by year end 2023. Okay. Now, the 3,800 to 4,200 range we were in, it implies GDP growth of less than 2%, or what some people call growth recession, sluggish growth. A 3,400 to 3,800 trading range, which if we broke 3,800 decisively would be our new lower bound, that would probably indicate a shallow recession, probably not lasting too long. On the other hand, 3,000 to 3,400 trading range would be likely if we had a hard recession or one that lasted longer. That's not our base case, by the way, but where we are right now at 3,900 on the S&P, we're really in no man's land. We're about 900 points down from the high of 4,800 early this year, and about 900 points up from the worst case scenario. So that's kind of, framing it that way, I think kind of helps put some perspective where we are right now.
So with all this uncertainty and volatility going on, what are you telling clients and what are you doing in the client portfolios?
Okay. Well, our asset allocation overall is unchanged from early this summer. We're for our standard signature portfolios are 54% core equities, 10% international equities, 30% fixed income, including short-term fixed income, 5% satellites, and 1% cash. Right now, we view the odds of a recession at 50-50. That's been unchanged now since early summer as well. So it all depends on what the Fed does going forward, whether we have a full inversion of the curve or not. But overall, since the beginning of the year, we've been getting more defensive, and right now we're at a pretty defensive position overall. And even in the equities that we're in, the equities are more of a defensive tilt with sectors like consumer staples and utilities, etc., being emphasized more than earlier this year, and we've cut back on some of the higher growth, higher PE names.
Thank you, Orest. We appreciate your insights as always, and we look forward to the next update. Thanks, everyone.
Thank you, Ashley. Take care, everyone.